The silver market is rarely the first place investors look when stress enters the global financial system. It is quieter than equities, less headline-driven than currencies, and often dismissed as a secondary monetary metal. Yet history shows that when silver begins to move in unusual ways, it is rarely acting alone, it is reacting. And right now, the behavior inside the U.S. silver market is no longer normal. Over the past several months, a pattern has emerged that does not fit retail speculation, industrial seasonality, or short-term price momentum. Physical silver inventories in the United States are being drawn down with unusual consistency. Large wholesale bars are leaving approved vaults. Delivery requests are increasing. And the buyers behind these flows are not domestic hedge funds or commodity traders rotating exposure. They are foreign banks. This matters not because silver prices are rising dramatically, but because of what this behavior implies about confidence. When foreign banks quietly accumulate physical silver from U.S. markets, they are not making a trade. They are repositioning balance sheets. Silver sits at an unusual intersection. It is both an industrial input and a monetary reserve asset. It is used in energy infrastructure, electronics, defense systems, and medical equipment, while also functioning as a store of value outside the banking system. That dual role makes silver sensitive not just to economic growth but to financial stress. When trust in paper claims weakens, physical metals begin to matter again. In normal conditions, silver markets operate on leverage. Futures contracts, unallocated accounts, and paper derivatives dominate price discovery. Physical metal rarely moves in size because it does not need to. The system assumes that claims can always be settled in cash, rolled forward, or netted out. But when participants begin to question that assumption, the incentive changes. Physical delivery becomes preferable to paper exposure. Foreign banks understand this better than most. They operate across jurisdictions, currencies, and regulatory regimes. They are exposed not just to market volatility, but to settlement risk, sanctions risk, and political interference. When these institutions start accumulating physical silver in the United States, it suggests a reassessment of counterparty trust, not a short-term bet on price appreciation. This shift is happening against a fragile macro backdrop. Global liquidity is no longer expanding evenly. Dollar funding remains tight in key offshore markets. Sovereign debt issuance is accelerating, while central banks are becoming less willing to absorb duration risk at scale. In this environment, collateral quality matters more than yield. Assets that can be held outside the financial system without reliance on counterparties regain relevance. Silver fits that requirement in a way few assets do. It is liquid, globally recognized, divisible, and historically monetary. Unlike gold, it is still small enough that institutional flows can materially affect availability. And unlike most financial assets, it carries no issuer risk. Within U.S. vaulting systems, this dynamic is becoming visible. Inventory reports show persistent outflows. Eligible metal is being converted to registered metal, then removed. Delivery notices are rising even when prices remain range-bound. These are not speculative behaviors. They are operational decisions. For a foreign bank, holding physical silver in the U.S. offers optionality. It provides collateral that is not tied to domestic currency systems. It can be mobilized across borders. And in a scenario of financial stress, it retains value independent of central bank policy responses. This is not a prediction of collapse. It is preparation for instability. If you value this kind of early warning macro analysis calm, structural, and focused on what institutions do rather than what they say consider subscribing. The key point is this. When foreign banks quietly draw physical silver out of U.S. markets, it reflects a change in how risk is being priced at the institutional level. It suggests that confidence in paper settlement, Abundant liquidity and frictionless markets is no longer taken for granted. And silver, once again, is being treated not as a commodity, but as a monetary reserve of last resort. This is only the first layer of the story. To understand why these banks are acting now, we need to examine the deeper stresses building inside the global collateral system, and how silver fits into a much larger realignment of monetary trust. What sits beneath the movement in physical silver is not speculation, but stress inside the global collateral framework. Modern finance does not function on cash alone. It runs on promises secured by assets that are assumed to be liquid, reliable, and universally accepted. Government bonds, particularly U.S. Treasuries, form the backbone of that system. They are pledged, rehypothecated, and reused across markets to support leverage and settlement. When confidence in that collateral weakens, the system does not break loudly. It tightens quietly. Over the last several years, the quality of collateral has been diluted. Sovereign debt levels have expanded far faster than underlying economic growth. Issuance has surged, while central banks have shifted from consistent buyers to hesitant participants. This has changed the character of government bonds. They are still liquid, but they are no longer scarce. And scarcity, not yield, is what gives collateral its power in moments of stress. At the same time, regulatory changes have increased the demand for high-quality collateral. Banks are required to hold more liquid assets. Clearinghouses demand greater margin. Cross-border transactions face higher buffers. This creates a structural imbalance. More collateral is needed, while fewer assets retain unquestioned trust. When that imbalance grows, institutions look for alternatives that sit outside traditional financial claims. This is where silver re-enters the picture. Unlike sovereign bonds, silver is not issued. It cannot be diluted by policy decisions. It does not depend on fiscal discipline or political stability. It exists as a physical asset with no balance sheet attached. In a system increasingly defined by leverage and interdependence, that independence becomes valuable. Foreign banks are particularly sensitive to these dynamics. Many operate in environments where access to dollar liquidity can be restricted suddenly, either through market stress or geopolitical action. They have seen how quickly reserves can become frozen, how payment systems can be weaponized, and how settlement assurances can be revoked. For these institutions, holding assets that bypass financial infrastructure is not an ideological stance. It is a risk management decision. Silver's role here is not to replace gold, but to complement it. Gold remains the primary reserve metal, but it is concentrated, expensive, and increasingly visible. Silver offers flexibility. It is easier to move in smaller increments. It is more embedded in industrial supply chains. And critically, it remains undervalued relative to its historical monetary role. This makes it suitable for accumulation without drawing attention. The mechanics of the silver market amplify these concerns. Paper claims on silver far exceed available physical supply. Futures markets, unallocated accounts, and exchange-traded products all rely on the assumption that most participants will never demand delivery. As long as that assumption holds, the system functions. When it does not, stress emerges quickly. Recent behavior suggests that some institutions no longer view paper claims as sufficient. They are choosing delivery over exposure. They are converting contractual rights into physical possession. This does not require panic. It only requires uncertainty. A small shift in preference, applied consistently by large actors, can strain a market built on leverage. This strain does not need to show up in price immediately. In fact, it often does not. Price suppression through derivatives can continue even as physical availability tightens. The signal appears elsewhere, in inventory drawdowns and rising premiums, in delivery delays, in changes to contract terms. These are operational symptoms, not speculative ones. What makes this moment distinct is timing. These flows are occurring while official narratives emphasize stability. Inflation is described as managed, growth is framed as resilient. Financial conditions are said to be orderly. Yet beneath that surface, institutions are adjusting behavior in ways that suggest caution, not confidence. Silver is not being accumulated because of a forecast. It is being accumulated because of doubt. Doubt about the durability of liquidity. Doubt about the neutrality of financial infrastructure. Doubt about the assumption that all claims will be honored smoothly in a stressed environment. This does not imply an imminent crisis. Systems can operate under strain for long periods. But it does indicate a transition phase where trust is being repriced and optionality is being rebuilt. Physical silver, quietly leaving U.S. vaults, is one of the more understated indicators of that shift. To see where this leads, we need to examine how these silver flows intersect with industrial demand, energy transition pressures, and the geopolitical fragmentation of supply chains, because the next layer of stress does not come from finance alone. It comes from the collision between monetary uncertainty and physical scarcity. The financial signal in silver cannot be separated from its physical reality. Unlike purely monetary assets, silver is consumed. It is embedded into supply chains that are becoming longer, more fragmented, and more politically constrained. This is where the story deepens, because the same metal being quietly accumulated by foreign banks is also becoming more difficult to replace. Silver demand from industrial sectors has shifted structurally. It is no longer tied only to cyclical manufacturing or discretionary electronics. It now sits at the core of energy transition infrastructure. Solar panels, power grids, electric vehicles, and advanced semiconductors all rely on silver's conductivity and durability. These uses are not easily substituted, and efficiency gains have limits. As energy systems scale, silver intensity remains stubbornly present. At the same time, silver supply has not responded in kind. Mine production has been largely flat. New discoveries are rare, capital expenditure has been constrained, and permitting timelines have lengthened. Many silver mines are byproducts of base metal operations, meaning output depends on copper, lead, and zinc economics rather than silver prices. This disconnect reduces the market's ability to respond quickly to rising demand. The result is a market where above-ground inventories matter far more than marginal production. When industrial demand tightens and financial actors begin to prefer physical ownership, pressure concentrates on existing stockpiles. This is precisely what is occurring inside U.S. vaulting systems. Metal that once functioned as passive inventory is being mobilized, withdrawn, and reassigned. Foreign banks are aware of this dual pressure. They are not only hedging financial risk, they are securing access to a material that may become strategically constrained. In a fragmented global economy, access matters as much as price. Holding silver within U.S. markets provides proximity to deep liquidity today, while preserving optionality for a more restricted tomorrow. Geopolitics reinforces this logic. Supply chains are being regionalized. Trade relationships are becoming conditional. Strategic materials are increasingly framed as national security concerns. While silver has not yet reached the political visibility of rare earths or semiconductors, it shares a key trait with both: concentration of production and lack of rapid alternatives. This creates an unusual alignment. Monetary stress encourages institutions to move toward physical assets. Industrial stress increases the value of holding those assets early, before scarcity becomes obvious. When these forces overlap, markets tend to adjust in nonlinear ways. Availability tightens quietly, then suddenly. What makes silver distinctive is that its price can remain subdued even as underlying stress builds. Because price discovery is dominated by paper markets, physical scarcity does not immediately translate into higher quotes. Instead, it expresses itself through friction, longer delivery times, higher premiums outside exchanges, reduced willingness to lease metal. These are subtle signals, but they are consistent. Foreign banks are positioned to read those signals. They sit at the intersection of trade finance, currency settlement, and industrial funding. They see where supply assurance is weakening and where contractual assumptions may fail under stress. Their actions suggest that silver is being reevaluated not as a tradable input but as a strategic buffer. This does not mean silver will disappear from markets. It means its role is changing. The more it is treated as a reserve-like asset by institutions, the less freely it circulates. That reduces elasticity. And reduced elasticity is what turns manageable imbalances into acute shortages when conditions tighten. The broader implication is not about silver alone. It is about how physical constraints intersect with financial systems built on abstraction. When trust in settlement weakens and supply chains lose redundancy, assets that bridge the monetary and physical worlds gain importance. Silver occupies that bridge. To understand the full risk, however, we need to look beyond silver itself and examine how these dynamics interact with currency systems, particularly the dollar, and the growing incentives for institutions to reduce exposure to any single monetary framework, because the movement of silver is not isolated. It is part of a wider shift in how value is being anchored. At this stage, the accumulation of physical silver begins to intersect with a broader monetary question: the durability of the dollar-centric system under rising structural strain. This is not about the dollar losing reserve status in dramatic fashion. It is about how institutions behave when the marginal reliability of that system begins to decline. The dollar remains dominant in trade, finance, and reserves, but dominance does not eliminate friction. Offshore dollar liquidity has become more episodic. Funding markets rely increasingly on central bank backstops. And the cost of accessing dollars during stress has risen for institutions outside the U.S. These conditions incentivize foreign banks to reduce their dependence on uninterrupted dollar access, even while continuing to operate within the system. Physical silver offers a form of monetary neutrality. It is not tied to any central bank, payment network, or political authority. In cross-border stress scenarios, this neutrality becomes valuable. It allows institutions to maintain a store of value that does not require dollar settlement, correspondent banking relationships, or regulatory approval to exist. This does not imply a wholesale shift away from fiat currencies. Rather, it reflects diversification at the margin. Foreign banks are not abandoning the dollar. They are hedging against its operational risks. In a world where sanctions, asset freezes, and payment restrictions have become normalized tools of policy, holding some value outside the system is rational. Silver also benefits from its relative invisibility. Gold flows attract attention. They are tracked, reported, and often politicized. Silver moves more quietly. Its markets are smaller, its narratives less charged. This allows accumulation without triggering market or policy responses. For institutions seeking optionality rather than confrontation, this matters. The deeper signal is one of confidence management. Financial systems do not fail when trust disappears entirely. They weaken when trust becomes conditional. When participants begin to ask under what circumstances claims might not be honored, behavior changes. Collateral preferences shift. Physical possession gains appeal. What we are observing in the U.S. silver market is consistent with that transition. It is not panic, it is preparation. It reflects a world in which institutions no longer assume that liquidity will always be available. that settlement will always be frictionless, or that political risk will remain abstract. To complete the picture, we need to examine how these quiet adjustments tend to resolve historically, and what signals typically appear before broader recognition sets in. Because markets rarely adjust all at once, they move in layers, led first by those closest to risk. History shows that shifts in monetary behavior are rarely announced. They emerge through small, rational decisions made under uncertainty. The quiet movement of physical silver out of U.S. markets fits that pattern. It reflects institutions prioritizing resilience over efficiency and optionality over yield. This does not guarantee disruption, but it does signal a change in assumptions. When foreign banks secure assets that sit outside settlement systems, they are acknowledging limits to trust. For observers, the signal is not urgency, but awareness. These transitions unfold slowly, then suddenly. If you see similar signals elsewhere, share your perspective in the comments. And if this analysis added clarity, consider sharing it with others watching the same fault lines.